We we looked at a statement of cash flows in the very, very early part of this course, like when we introduced the idea of an income statement and a balance sheet and a statement of retained earnings. We also looked at the statement of cash flows, but the statement of cash flows is confusing enough that I think it's best to leave until toward the end of the class to dig into it a little bit more. So we've learned by now, because we're smart and we pay attention, we've learned that revenue and expenses don't always match up with cash flow. And what I mean by that is sometimes we have revenue that we earn, but we're not going to get paid for it until later. So our income statement will show revenue, but we haven't got any cash for it yet. Sometimes we'll get cash before, but we won't earn the revenue until later. So we'll have this cash, but we won't show any revenue, right? We had to learn all of that with the adjusting entries. Sometimes we'll have expenses that we've paid early, right? And it creates that prepaid asset like prepaid rent or prepaid insurance. So we show this money that we paid out, but we don't have an expense. And sometimes we have expenses that we pay out now, or so that we incur now, but we won't have to pay them until later. Like if somebody says, "Oh yeah, pay us in 90 days." So the expense comes up, but we haven't paid it. Sometimes we have expenses like depreciation expense, where we paid for that building a long time ago, but every month we're still claiming part of its expense, right? So we'll have these situations where our revenue minus expenses, which gives us net income, will be one thing, but the amount of cash we actually brought in will be very different from that. And so to help with that, we create a statement of cash flows that shows actually how much money is coming in and how much money is going out. Like, think about the statements we've been using. An income statement shows your revenue. If you have a net loss, meaning you have more expenses than you have revenue for 1 month, can you continue to operate? Or are you just out of business? Yeah, you could continue to operate, especially if you had a lot of money in savings. Like if I had a checking account with $1 million in it, but I lost $1,000 this month, had $1,000 more expenses than I had revenue, I could do that for 1,000 months, right? Before I ran out of that savings account. It's kind of like your own personal finances. If you have savings, some months you'll actually put some money away. You got some extra money. Maybe you had birthday or something, and so Granny gave you a $50 bill because she's sweet. But then another month, you might spend more than what you brought in that month by spending everything you brought in plus some money out of your savings, right? That's pretty normal. Okay. So I've always said like an income statement partnered together with your balance sheet is kind of like a health screening for the business. If a business is running at a net loss, it can continue to do that for a time as long as it has sufficient reserves or sufficient access to borrowing, right? If a business's liabilities are beginning to grow, that's a warning sign. We can't do that forever, but we could do it for a short period of time if we need to. We can run at a loss for a short period of time if we need to. It's pretty common in some businesses to run at a loss for a year or two before they really start making a profit. So what they have to do is get sufficient capital to sort of sustain them through those periods of loss. So think of those as like a health screening. And then the cash flow statement, which we're going to learn about today, is more like an EKG, right? Like the heart monitor. Because if you run out of cash, you're just dead. You can't operate anymore. You know, if you don't have any savings and you don't have any access to borrow some, you're done. How many of you have a job right now? A few of you, yeah. You like your job? No, I saw a no, or it's okay, or I do like it. I love my job. I get to be with you guys. But if they didn't pay me once even, like, oh, we messed up and we just don't have the money to pay you guys, but we'll have it next month. Do you think I'd be looking for another job? Right? Like the minute you run out of money, your employees start jumping ship. Like you might have some really dedicated employees who are like, we trust you, boss. Like we'll wait till the next paycheck. Federal government's going through this right now, right? We have a federal prison here in town, and we have a whole bunch of people who just haven't been paid in a month. And so they're not loving that, right? Some of them had savings, they're okay. Some of them, the minute they miss their first paycheck, they're in trouble. They couldn't make their house payment, right? So just recognize as a business, revenue and expenses are one thing and cash is another thing altogether. And so we have to have a statement to track the incoming and outflowing. They actually call it inflows, meaning money coming into the business, and outflows of cash. So generally, this is the format for a statement of cash flows. We break it down into three sections. We have cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. And then we add those all up, and that gives us the net increase or decrease in cash. And then you put the cash at the beginning of the period plus the cash increase or decrease will give you the cash at the end of the period, and they should match up. Your balance sheet will show cash, right? That's on the balance sheet. So we already know how much cash will be at the beginning and end by looking at the beginning of the period's balance sheet and the end of the period's balance sheet. This will kind of map out how we got there. So we already know the answer, how much cash we have. This will help us track how we're bringing in cash and how it's going out. So this is generally what a statement of cash flows is going to look like. And let's take a look at how we actually do it. All right. So understanding the sections of it. So operating cash flows are the money you bring in from running your business. Okay. So that involves selling stuff to people, providing services to people. So really selling stuff to people, either goods or services. And cash outflows are all those expenses to buy new inventory, to pay our employees, to pay our taxes, all of those things. So operating means just the normal day-to-day operation of the business. That's one way we bring in cash and pay out cash. The second section, investing, is any money that we bring in by selling property, plant, or equipment. So, we're not in the business of selling off a building, but every once in a while you have a building that you're like, we're not going to use this, and you sell it to somebody. That would be an investing cash flow. Also, the sale of investments. So if we've bought the stock in another company, sometimes people will buy the stock in their competitors, their suppliers, so they're part owners in them. So if you sell some of that off, that'd be a cash flow from investing activities. Really, it's the selling or buying of assets, okay? And then a negative cash flow would be like buying property, plant, and equipment. We buy that new building, we buy a new piece of property. That would be cash flow that we're investing in something in the future. It's not an expense yet, right? We're just buying into this other asset. And then finally, financing activities. This is any borrowing, long-term, or issuing stock from our company. So when we issue new stock, bring in cash for that. That's a positive cash flow from financing. If we issue a bond and bring in cash from issuing the bond, those are cash flows from financing. And then negative cash flows for financing would be things like paying dividends, repurchasing or buying back some of that stock, or paying off our long-term debts. Okay, so remember those three categories. That's going to be important and kind of what each of them means. Here's where it gets dicey. As usual, there's always this part, right? There's two different methodologies that are used for creating a statement of cash flows. The first is called the direct method, where we report all of our operating cash inflows and outflows in this way. It just says cash flows used or from operating activities, and then just lists them all. So this is why it's called direct. We just list them. Cash we received from our customers, cash we paid for inventory or merchandise, cash paid for operating expenses, cash paid for interest, cash paid for income taxes, net cash flow for operating activities. That to me seems nice and simple, right? And so that's the direct method. But this information isn't always readily available to us from the other financial records, the income statement and the balance sheet. So even though this is as usual, if you think about the things with like the adjusting entries, even though this is the easier way, it's not the way most people use, because it's not really easier in the sense that you don't always have direct access to all of the information you need to do it. Anyway, so that's the direct method. And just so you know, there's the direct method and the indirect method. For both of them, there's a difference in how we deal with the operating cash flows, but the financing and investing cash flows are the exact same for both of them. So they're only different on the operating cash flows. Okay. So what most people use is the indirect method. And this, it's called indirect, is because we're going to use the income statement and the balance sheet together to calculate our cash flows. So what we do is we start with the net income. So if a business was purely cash and always paid all their bills in cash and always received all their payments in cash. So a lot of small businesses are this way, right? They don't sell things with credit cards or anything else. They don't extend credit to their customers. They don't borrow from their suppliers. They just pay cash. Then their net income and their cash flow would be the same, or their net income and cash flow from operating activities would be the exact same. So we start with that assumption, and then we make adjustments to reconcile net income to net cash flows, which I'll show you how to do in a second. And that will give us our net cash flows. So here's the two of them side by side. This company has it nice and easy. So this is the section that is for operating activities. Remember the other two sections, financing and investing, will be the same either way. So with the direct method, it shows cash received from customers, cash paid for expenses and to creditors, gives them a net cash flow of $2,900. Again, though, nowhere on the income statement or the balance sheet does it say how much of your customers paid in cash. It just shows revenue, right? So you don't really have that very easily. So instead, we tend to do this, which is the indirect method, where we start with net income. That's on the income statement. Then we show there's an increase to accounts payable and an increase in supplies. Those are the adjustments, and that gives us the net cash flow. Okay, so these are the two different methods, and we're going to focus mostly on the indirect method because it's the one you'll see in the wild. If you go out and work in accounting, you'll be like, oh, that's the indirect method. That's the one Fox told us about. All right. So here's an income statement for a company, Rundell Incorporated. You can see they had sales of 1.18 million. Pretty good. Not a bad year. Their cost of goods sold was 790,000. That's like 70% of their revenue. So that's they need a higher markup, but maybe they can't do it. Sales minus cost of goods sold gives us a gross profit of 390,000. Then they have all their operating expenses, and that gives them a net income. So the reason I'm showing you this is as an example. I'm going to show you how we would go through and do the indirect method to figure out their net cash flow from operating activities. So we need an income statement and we need a comparative balance sheet, which means it shows the last 2 years balance sheet, this year at the end of the year and the previous year at the end of the year. The reason we do that is because it will show us the change in all of these items over the previous year. Okay. So it actually, you'll see like cash was 26,000 at the end of last year and 97,500 at the end of this year. And then it just subtracts to show you the difference. So this business has $71,500 more cash than it did last year. That's pretty good. Would you like to have $71,500 more cash than you had last year? Of course you would. Except if I did, I'd probably be buying stuff with it and then I wouldn't have more cash, but I'd have stupid crap I didn't really need. Maybe you guys aren't like that. Amazon calls you when you have extra cash. Accounts receivable, inventories, and then there's land building, etc. Then we have accounts payable, accrued expenses, income taxes payable, dividends payable, etc. All right. So in order for us to figure out our, let's see what I have here. In order for us to figure out what our cash flow from operating activities was, what we're going to do is we're going to start with our net income, and then we're going to make adjustments for changes in current assets and current liabilities. Okay. I'll explain to you why we make those adjustments as I'm showing you, but it can get confusing. So if you first put your energy into remembering what the change will be, and I'll explain the why, but focus on the what, then if you do it more, say you have a job somewhere where you're actually having to do this, you'll understand more and more and more about the why. And if you don't, then you'll learn enough right here to get through the problems and move on with your life. Okay. So there's a what and a why to almost everything. Some things that really behooves us to understand the why. But you think about that for your own personal study of things where you're trying to grow. And you usually start with what do I have to know? And then in time you begin to understand, oh, this is why I had to learn that, right? So it's okay. All right. All right. So here's what we do. We start with net income. That's the first line we would write down. So like our net income for this example was $108,000. Where's my pen? So net income, $108,000. There's my starting point. And again, what I'm trying to figure out is how much cash flow from operating activities did I have? Once I've done that, started with my net income, the next thing I'm going to do is I'm going to make adjustments that will reconcile the net income or loss to the net cash flows. Okay. So step one, after putting in the net income, is to add in any depreciation expense. Why do you think I would do that? Remember, what I'm trying to do is figure out how much cash actually changed. What's that? Well, yes, for some of the expenses, right? Right. So you're onto something. All right. So net income is my revenue minus my expenses, right? But not all expenses are cash expenses. Depreciation expense is an expense, but I didn't have to pay any cash for it. Remember, I paid cash years ago when I bought that building or whatever, and now I'm claiming depreciation for it every year. So I add it back in because even though depreciation expense decreased my net income, it didn't decrease my cash. So to reconcile my net income to my cash, I add my depreciation back in. Okay. That's the why. The what to remember, if you're like, I don't get the why yet, is add depreciation back in. That's the what. All right. So I'm going to just go and look at my income statement. And right here, I'll see I have a depreciation expense of $7,000. So I'm going to add depreciation. How much was 7,000? That was step one. The same thing for amortization. If you've amortized things, which is like depreciation, but has a different name, right? Step two, I'm going to deal for losses on disposal of assets or gains on disposal of assets. So what this means, if I go back to my income statement, you can see I have down here under other revenue and expense, I have a gain on a sale of land. So I've got to adjust for that. Okay. So here's why. If I sold land and I got a gain, meaning I sold it for more than its book value. Remember when I sell things like this, we've learned about it in the past. I'll do a journal entry, like for a piece of land, that in essence, if the land had a debit balance of $100,000 and I sold it for 112,000, I would do a journal entry that credited the land 100,000, the land went away, and it credited something like gain on sale of land, $12,000, which is a revenue. That ends up increasing my net income, but it's going to be reported down in that non-operating section on the other income section. So if I count it here on operating cash flows, and again in the investing cash flows, I'm going to be double counting it. Okay. So all my gains, here's the what, any gains from sale of assets, I'm going to deduct off, and any losses from sale of assets, I'm going to add back in. Why? Because they're going to be accounted for in another section, and I don't want to double count them. So the what is when I'm making these adjustments, if there's any gains, I subtract them. Any losses, I add them. Okay, that's the what. And the reason why is because they'll be counted somewhere else later, and we don't want to double count them. All right. So step 2, we're looking for losses or gains on disposal of assets. And so I have a gain on a sale of land of 12,000. So I'm going to subtract this gain on sale of land. And then finally, step 3, which is I'm going to make adjustments for changes in the current operating assets and liabilities. The what? I'm going to subtract increases in non-cash current operating assets. I'll explain this a little bit more. And I'm going to add decreases for non-cash current operating assets. And then I'm going to add increases for liabilities and subtract decreases for liabilities. That's confusing. So let me show you it in the example and explain it a little bit better. So I'm going to look at my balance sheet and I'm going to see what's changed. My accounts receivable has gone up by 9,000. My inventories have gone down by 8,000. The rest of these are not current, right? Land, building, those are all long-term assets. So the only adjustments I'm making are for changes to my current assets, not counting cash. So accounts receivable and inventories. The what is, I always adjust for current asset changes in the opposite direction. So if current assets went up, I'm going to adjust cash down. And if current assets go down, I'm going to adjust cash up. So if you can remember, adjust for assets, opposite direction, right? Current assets went up, we adjust cash down. Here's why. I'll tell you the why. If my accounts receivable goes up, right? What's accounts receivable? Anybody remember? Yes, money people owe you. And so if my accounts receivable goes up, what does that mean? They owe me more than they did at the beginning of the year. Okay. And so that means that all of the revenue I've reported on my income statement was not all collected. Right? Because if I sold stuff to people and they all paid me for this year, then my accounts receivable would be exactly the same at the end of the year. Right? Even though I would have earned revenue in the middle, if everybody paid me for everything they owed me, it wouldn't change for everything they owed me during the year. So if I record all this revenue, but now I haven't collected 9,000 of it, I have to show that even though my revenue went up by all of that plus the 9,000, not all of that revenue was collected in cash. So I'm going to, for an increase in assets, I'm going to do an adjustment of a negative to cash. So the what is, with changes in assets, we do the opposite. If the asset goes up, cash goes down. If the asset goes down, cash goes up. The why is what I just explained, and it can get confusing. I've talked myself in circles on it 100 times. So just remember the what. So accounts receivable, it went up. So we're going to subtract the amount it went up by, 9,000. And then inventories, they went down by 8,000. So we're going to add that. And again, the why is that, well, if my inventory is going up or going down, it means that I haven't spent the cash to replace that inventory. So I sold it, and usually you would expect to just replace it, but for whatever reason, I let my inventory trickle down. Okay. So again, remember the rule when we make these adjustments for assets, it's just in the opposite direction. If the asset went up, cash goes down. If the asset went down, cash goes up. Okay. You'd be surprised when you're doing audits and helping businesses who are struggling with their finances. You'll find a good sign that they're in trouble financially is that inventories will be steadily decreasing. And that's because they're feeling the pinch, like they don't have much money. And so one way to sort of get away with it is instead of always having, 100 of those items on hand, maybe now they're only going to carry 75 of those items on hand, which no big deal, right? We call it eating off of their inventory because like if you owned a food store, you would actually like be taking some of your inventory to eat so you didn't starve to death. And then over time, you'll see it go down to the point where then you start having problems with customers not being able to find the products they want because they're not maintaining inventories, and the customers start going to other places, and then their revenue drops. And so that's one thing I look for when I'm working with businesses is like, what's happening with your inventories? And if so, is there a why? Because sometimes there's a legitimate reason, like, oh, we just decided to stop carrying this expensive item because no one was buying it. Okay. But anyway, so those are our adjustments. And then we'll look at liabilities too. And the current liabilities, so accounts payable and accrued expenses, which means our operating expenses, and the income taxes payable, these are all ones we're going to make adjustments for. With liabilities, we make the adjustment in the same direction. So if the liability goes down, then we adjust down. So accounts payable, 3,200. And accrued expenses, 2,200. That one goes up. What was there? 2,200. Income, let's see. I can write all these out. I think you're getting the picture at this point. So then at the end, this is what our statement of cash flows looks like. The net income, we're going to add the depreciation back in, subtract the gain on the land, and then make all of our adjustments. The increase in accounts receivable, we did a negative adjustment, or for the assets, we did a negative adjustment. The decrease in inventories, we added it. The decrease in accounts payable, we decrease because that's a liability going down. The increase in accrued expenses, the decrease in income taxes payable, and at the end, we get a net cash flow from operating activities. Okay. Probably should do some practice with this now since we've seen the idea of it. If you came in late, you just missed a lot of crap and your brain's going to be like, I don't know how to do this. But you're still a good person, just a tardy good person. All right. Let's take a look at our guided assignment. All right. So state the effect, cash receipts or cash payment of each of the following transactions. So we retired $500,000 of bonds on which there were 4,000 of unamortized discount for $510,000. Woo. Okay. So we have to think what actually is changing from a cash perspective. And really, so these will trick you because it's like you see all these different numbers, but this four or 510,000, that's how much cash we actually had to pay, right? So our cash is going to go down, or there'll be a cash payment of $510,000. Remember, a bond is a liability, right? So if we had a negative, so if we pay a liability, remember liabilities are the same direction. So we're reducing the liability, we're reducing cash. Remember that rule. Sold 20,000 shares of $5 par common stock for $30 a share. Again, if we were doing a journal entry, we'd have to worry about how much of this was at par and how much of this was at in addition to par. Here, we're just worried about the amount of cash flow. So I'm just going to say 20,000 shares times $30 a share is going to be a cash receipt of 20,000 times $30, which is 600,000. So this involves thinking about like what's happening here. If I sold stock, my cash is going up. If I paid off a debt, my cash is going down, right? That's pretty logical when you think about it, but it can get confusing at times. C, we sold equipment with a book value of 68,900 for 72,400. Again, when we're talking about how much cash we got, we don't care about book value. This is just going to be a cash receipt of $72,400. D, we purchased land for 825,000 in cash. What's happening? It's a cash payment, right, of 825,000. You're like, wait a minute, this is incredibly easy. All right. E, we purchase a building by paying 30,000 in cash and issuing a $570,000 mortgage note payable. What do you think happens there? Yep, cash payment of 30,000. It can be like, wait a minute, but what's happening with this other thing? Whatever the other thing is that's happening, which is they're borrowing 570,000, it's not cash. So for this, we're just worried about cash. There'll be other consequences that will involve cash later down the road, but right now they're just paying 30,000 in cash. F, sold a new issue of $400,000 bonds at 98. Ah, here they're tricking us. Because if a bond is sold at a discount, then we're not getting all the cash of the face value, right? So we'd have to take 400,000, which is the bond value, and say, well, how much cash did I get? 98% of that. Whoop. So we actually got a cash receipt of 392,000. Purchased 10,000 shares of $10 par common stock as treasury stock at $22.50 a share. So are we going to use the par, or the amount we actually paid for this, right? Yeah, good. So 22,500 times 10,000 is 225,000. And that's a payment. We're paying out cash. So I think the point they're getting at here is the trick is to recognize how much cash is actually changing hands, not how much is it going to affect our books. Paid dividends of $1.25 per share. There were 1 million shares issued and 180,000 shares of treasury stock. They're messing with us again. We know that we know, because we're smart, that we don't pay dividends on treasury stock. So I'm going to take 1 million shares minus the 180,000 that are treasury stock, which tells me how many shares of stock I have outstanding, 820,000. And then I'm going to multiply that by $1.25, because we're paying dividends of $1.25 on each outstanding share. And that gives me 1,025,000. That's a cash payment, 1,025,000. Hooray! All green check marks. Those bring joy to all the children. All the who's in Whoville. that are on Cengage. All right. All right. Number 2, indicate whether each of the following would be added or deducted from the net income in determining cash flow from operating activities by the indirect method. All right. So the trick to these then is to say what type of account is this and what's the rule, right? So a decrease in inventory. What type of account is inventory? An asset. So when with assets, it's opposite, right? So a decrease in inventory would be an addition to cash for the adjustment. An increase in accounts receivable. What type of account is accounts receivable? It's an asset. If an asset's increasing, then it will be a deduction because assets are opposite. Increase in accounts payable. Accounts payable is a liability. And so with liabilities, it's the same, right? Meaning if a liability increases, we'll be adding cash. They go, so increasing goes with increasing. A loss on the retirement of long-term debt. What do we think about that one? Anytime we have losses that are not part of our operating, okay, we're going to add the losses back in. So we're going to add it. If we have gains that are not part of our operating, we're going to subtract the gains back out. That's because those are the ones being reported in a different section of the cash flow statement. All right, E, depreciation of fixed assets. We always add depreciation back in. Remember that was step 1. F, decrease in notes receivable due in 60 days. So notes receivable is an asset. So we do opposite. So if the notes receivable is decreasing, we'll be adding. Salaries payable, that's a liability. So we do the same. So if it's an increase in a liability, we'll be adding. A decrease in prepaid expenses. Anybody remember what kind of account prepaid expenses are? It's a good guess, but it's not it. It's an asset. It sounds like a liability. I don't blame you because I do it all the time. It's an asset. It means I paid in advance for something, right? So if it's an asset and it's decreasing, then we're going to do the opposite with an asset and deduct it. Oh, wait. No, sorry. The opposite is adding. Yes. Add. Amortization of a patent. Remember, amortization is like depreciation. It means we're just writing off the value of it as an expense over time. So it's one of those non-cash expenses that we will add back in. Increase in notes payable due in 120 days. So notes payable is a liability. So if it increases, we'll increase or add. Finally, a gain on the disposal of a fixed asset, we'll deduct. All right. So those first 2 are kind of the tools we need to actually be able to do a statement of cash flows. And since we only have 3 minutes left in class time, I don't know that I want to jump into this whole thing. Well, we might be, I think we can get it. So let's look at it. The net income reported on the income statement for the current year was $93,700. Depreciation recorded on store equipment for the year was $31,200. Balances of the current assets and current liability accounts at the beginning and end of the year are as follows. So it gives us all those balances. So again, we just follow those steps. So first we start with net income. And this tells us it was 93,700. And now we're going to do the adjustments. And the first adjustment we're going to do is the depreciation expense. We're going to add that back in because it's a non-cash expense. So depreciation, and that's 31,200. Does that help? Okay. Then we make these adjustments for the changes in our current assets and liabilities. And remember, we exclude cash from this. So we'll start with accounts receivable. Accounts receivable is an asset, and it went up by To find the difference, we would just subtract the end of the year minus the beginning of the year, and we see that it went up by $9,000. So if an asset went up by 9,000, we're going to adjust down by 9,000 because assets are opposite for this. Inventories, they went down by 2,800. So inventory is an asset. I'll put this over here. Inventory is an asset. So if we had a decrease in inventories of 2,800, we're going to adjust up because we do opposite with assets. Prepaid expenses, these are also assets. Had 3,250 at the end of the year, 8,000 at the beginning. So our prepaid expenses, they went down by 4,750. So we're going to say decrease in prepaid expenses. And we're going to add that because assets are opposite. All right. Accounts payable. So now this is a liability. We had 23,400 at the beginning of the year, or I mean at the end of the year, minus 17,200 at the beginning. So our accounts payable went up by 6,200. With a liability, it's the same. So if it went up, we're going to adjust cash up. And finally, wages payable. Went down by 1,100. So we'll do decrease in wages payable and we'll subtract. So just remember, assets adjust in the opposite direction. Liabilities in the same. We'll add all those up, which will give us, we'll just add all of this, 93,700 plus 31,200 minus 9,000 plus 28, and that will add up to 128,550. The last question, cash flows from operating activities differs from net income because it did not use the blank of accounting, and that's the accrual basis. For example, revenues are recorded on the income statement when they are earned, as opposed to when we actually get cash. And there we go. So there's our introduction. We'll do more, not tomorrow, because tomorrow's Veterans Day, but we'll do more on this on Wednesday. Okay? Have a great day. Sorry I went over by 2 minutes. To be fair, most of you didn't get here till at least 4 or 5 minutes after. So you're still good people. I still think you're terrific. I don't think that'll get me fired. Probably some of the inappropriate things I say in class would be more likely to get me fired. All right. Hold on, let me pause this.